So morning everybody, I'm Ellie Lister, I'm the Operations Director at Lendology CIC. Today I'll give you a quick overview of who we are, what we do, and then talk more specifically about our empty home loan scheme. I'll take questions at the end because I always have lots, which is great. But first of all, Lendology are a social enterprise lender. We're based in the southwest of England, and we've been working with local councils since 2003. So when we were established in 2003, it was when the UK government said that they wanted to reduce the reliance on grants for homeowners, and they wanted people to come up with, councils to come up with innovative ways to recycle the money they had. So we bid to government for a pot of money to set up the loan scheme with the consortium of 10 local councils. And basically, we lend the council's funds on their behalf to a range of homeowners to help with home repairs, adaptations, energy efficiency, empty properties, private sector landlords, anything within the private sector that helps improve housing outcomes to improve health. Since our original councils joined, we then worked with Devon to set up another scheme, and we're currently talking to councils right across the UK about setting up schemes. The joy of the pandemic was that it helped us to change our whole delivery model. So whereas before we used to go and see people in their homes, which meant obviously we could only be quite regional, in the pandemic we said, right, do we furlough everybody and shut the business, or do we go online and on the phone? And that has worked really, really well, which means we're able to deliver pretty much double what we've been able to deliver in the past, but still give people the same supportive service. We're members of APSI, the Association of Public Service Excellence. We do a lot of work with attending their events. Just helps us show our commitment to working with councils and understanding their current policy issues, and how we can work together to develop schemes that help to solve those issues. A lot of those are focused, as you would understand, on net zero and how do we get houses more energy efficient, but empty properties are very much my passion as well. Having worked at Lendology for 12 years, I've worked on like a really big variety of projects. So let me see, is my slide going to move on? So yeah, to date we've lent over 20 million, over 12 million of that has already been repaid. Doesn't mean I've lost 8 million, it just means it's still out there and it's getting repaid monthly. 87% of our loan applications are successful. Doesn't mean 87% go ahead, but it means Lendology can say yes to that amount. Sometimes people have a chat with us and they decide to do the works later, or to borrow elsewhere, but we were set up to service people who wouldn't necessarily be able to access finance elsewhere, maybe because they're retired, they've got bad credit history, maybe they've got benefits as their sole income. So our sort of fact find meeting with each of our clients, regardless of their sort of financial standing, if you like, is very, very thorough, and that's what makes us different to other lenders, I guess. So home improvements probably make up about 70% of our book. So that's people who are owner occupiers, live in the house, they need to do works to it. But we do the empty property loans and landlord loans, which someone might be a landlord, but they're renovating an empty property to bring it back into use. That probably makes up about 25% of our book. And we find it's over the last couple of years where lenders have tightened up their books, particularly for people who are self-employed, who might not be able to evidence strong income over the last 3 years because of the pandemic. We found that we're getting a lot more inquiries off the back of this. I also think because of the works the councils are doing with the increased council tax premium, that is actually now driving a lot more activity for people to do things with their empties. So that's really encouraging to see. So in terms of our loans itself, I'll talk through what we do with our current partners at the moment. But when we look at setting up a partnership with councils, we can very much tailor what we're delivering based on the needs of each council. So at the moment, all of our councils have agreed to offer 4% fixed interest. But you guys might say, well, actually, you know, the Bank of England rate is higher than that, so we want to lend at 6% or 7%. You know, you might say, well, we want to have a sliding scale based on the needs of the client. You know, that's absolutely fine. We can discuss that. But currently, everybody who applies to us gets 4% interest, and that's regardless of how much they borrow or their circumstances. We don't pass on any setup fees to the clients, but we do register a title restriction at the land registry, which costs £20. And what that does is it means if someone sells the property in the future, we would be notified and expect to be repaid at that time. Now, I understand that property ownership is very different in Scotland. I haven't researched it yet, but we've got a new team member who has that as their objective for this year, to understand the different landscapes and the different things we could apply to protect council money. So that's a project we're working on at the moment. With all of our loans, there's no early repayment charges. So with our capital repayment loan, that could go up potentially to 15 years. A lot of clients, you know, if they have to spend 15,000 on their roof, they want to keep their repayments to a minimum, but have the flexibility to overpay at any time. We lend a minimum of £500 up to £20,000 or more. Now, with empty properties, a lot of our councils have a higher limit because obviously they can be very complex and expensive to bring back into use. So some of our councils will say, okay, well, we can do 25,000 on each unit. So if you've got a sort of an HMO or a block of flats and there's 8 units, you'd look at 25k per each. So again, this is all sort of policy information that we could work with you to work out, you know, what is the loan scheme trying to achieve and what features of the loan do we need to have in place to achieve that with you. So in terms of our loan products, we have capital repayment and deferred capital repayment. Now, those two products are the most often used for empty properties, and particularly our deferred capital repayment. It's really attractive to people with empties, because what it does is it says, right, we'll give you a period of from 6 months up to 2 years where you don't make any monthly repayments, but obviously interest accumulates. Then once you've got the property back into use, you can start making your monthly repayments. So for somebody who's going to rent the property, that's really attractive. Also for someone who's going to renovate and sell, that is attractive because it means they're not having any monthly outlay, and then when they sell within that period, they just repay the accumulated interest and the capital borrowed. So what that makes us is sort of really, really cheap bridging finance, if you like. And some people say, well, why should the councils provide really cheap bridging finance? Well, ultimately your aim is to get these properties back into use, which is you know, much more valuable. So yeah, I've covered that slide. You know, we don't specify what people do with the property once it's been renovated. So it used to be in the past, the councils would specify, right, well, we'll lend you the money, but we're going to take nomination rights for 5 years. Lovely idea, but what it meant is very, very little take up of the loan scheme. So we've actually, I don't know any of our councils who have that in place. Some of them might have an option with more enhanced features, so you know, or we'll give you a grant towards it if you give us nomination rights, that kind of stuff. Or you'll get a lower interest rate if you give us nomination rights. But the majority of our councils now say, look, yeah, you can either renovate and sell it, renovate and rent, or renovate and move in. And we would, in our financial assessment, tailor the loan that we offer based on what the client was intending to do with the property. So a couple of case studies. The one I love is, you know, people who inherit properties that are just in such a state they can't really sell them, but they're in areas where you know, there is a high need for housing, particularly with like first-time buyers. A lot of the times these empty properties are unmortgageable because they don't have a functioning bathroom or kitchen. So we're able to go in. We don't have those restrictions. You know, we take on the risk really, but we say this is a good proposition. And these guys borrowed 20,000. We're able to renovate it and get it sold to a local family. Another situation was a property in a city with a high volume of students. So the landlord borrowed 45,000 on a 2-year deferred period. He said to me, well, what I'm going to do once the property is mortgageable is to remortgage and repay you at that time. So this was a short capital injection to get that property over the finishing line. So it works for the landlord and it works for the council, because again, they've turned a prime property into a home. So yeah, as I said, we're different because we're able to look at everybody's situations on a unique basis. We can also lend to charities or companies who own properties as well. We're seeing a lot more sort of commercial developers go, 4%, that's a really interesting rate, and start talking to us. We've got a fantastic video of a recent commercial development project where the clients were so pleased they've done us a lovely case study online. So do feel free to have a look at that at your leisure. So in terms of our application process, as I say, people who can self-serve online makes it really easy and quick. We get all their information, we review it, and then have a chat with them about how it fits with their council policy and how we're going to make the loan work. We do still offer home visits for vulnerable people or people who don't have, telephones, or they're just unable to cope with the application, and that doesn't tend to be for empty properties. It's more about vulnerable owner occupiers. We get a lot of referrals from organisations, so like maybe community energy groups, people who are going to visit people in their homes, chat through the problem. They can refer into us as well. And it's all about an informal chat, and applying doesn't affect people's credit scores as well, which is also something that people like about us. And it's no obligation. So I might have 5 chats with people 1 week and they don't come back for 2 years because it's taken them that long to work out how they're going to do the project, to get architects' plans, to get planning, but just having that initial chat with us gives them the momentum and the impetus to drive forward with the project. So I whistled through that, but I think I'm on time, which is good. Do follow us on socials. We do loads of case studies on there. I'll send Sam the presentation slides. You've got a copy of that, and then you've got our details as well. So do get in touch if you'd like to discuss partnerships. So let me stop sharing my screen. I can see you all, which is lovely. Any questions? Ellie. Have we got time for questions, Sam, or do you want to do them at the end?
I think we have a brief time for some questions, but also bear in mind that our next speaker, Stephen, is also discussing a case where Stephen had worked with Lendology as well, so there may be further time for questions after that as well. Any questions from anyone just now regarding Lendology?
Wendy.
All right, yeah, Wendy?
Hi. Is it possible to borrow for commercial properties as well, or is it just for residential?
Yeah, we haven't done any commercial properties, Wendy, to date, but if that was something you wanted to look at, there wouldn't be a reason we couldn't.
Okay.
I think that's probably based on the sort of ethos of where it all came from. It's the setup very much replaced the sort of renovation grant arrangement. So it's got that ethos of helping homeowners to live in safe housing. And it's not, but I suppose as Ellie said, if you want to do something with commercial dwellings, it's your money, you can target it in those areas, but that's why we've not gone down that route. But there'd be no reason why, if you want to do something over the shops or something like that, the commercial space into residential, then that would be entirely possible.
Gillian, you had your hand up there.
Hi, yeah, just a couple of questions. You mentioned about charities. Would you lend to community groups and community organisations if they're not a formal charity?
Again, if the finances stack up, then yeah, we can consider any entity if you like. Yeah.
Okay, and the other question is, does it have to be a property? Would you lend for the purposes of land development, in terms of if an organisation were looking to build on it, would you part fund that? You know, would you provide a loan to help them build on land?
That's an interesting question. We've got a lovely scheme based on one of our national parks here that is to help people who live on the national park, if they found some land to sort of inject capital to self-build. I suppose one of the problems is our loans are relatively small because our capital is funded by the council, so you'd have to look at the project overall, but sometimes it's sort of seed funding to just get the architect's plans, get a percentage done, and then they get commercial finance from elsewhere. So yeah, again, something we could look at.
Okay, thank you.
So I think I will move on to the next speaker, because bear in mind, that also is involving Lendology, so there'll be time for some questions after that. If that's okay, over to you, Stephen.
Good morning. It's great to talk and connect with colleagues in Scotland. Before you all disappear and I start sharing my slide, I'll just introduce myself. My name's Stephen March. I'm a environmental health officer and team leader at Dorset Council. I manage a small team that carries out all private sector housing activities, from HHSRS, HMO work, and the two main projects that I've been involved with recently has been quite a big project around long-term empty properties, and also minimum energy efficiency standards in rented accommodation. So, it's a wide-ranging remit. Let's do the share screen thing and see how we get on with that. Okay,
looking
hopefully,
good.
Is it looking good? Okay, right. So as Ellie said, just some things in Scotland. Obviously, some of the arrangements might be different. So if there are any questions about that, then we'll pick that up in the end. So the plan here is to provide you with a case study, basically, how we practically implemented the loan system for this long-term empty property that you're looking at in front of you. I will stray into other areas, not just sort of Lendology work, to sort of tell the story, but hopefully it will be of interest, and we can it will generate some discussion. Okay, so this is the property, 25 West Street in Blandford Forum, which is a market town in Dorset, and it had been unoccupied for 22 years, and it was the third longest unoccupied property in that part of North Dorset. We had tried to work with the owners in the past to try and do something about it, but we didn't have the products or the sort of the right levers available to make it happen. So it was one of these properties that was hiding in plain sight. Basically, it was on quite a busy sort of thoroughfare, but it didn't generate any complaint, probably because it didn't have a front garden, so there was no sort of overgrown garden, rubbish, rats, that sort of thing that would generate complaint. It was Grade 2 listed. It's not a particularly attractive building, but it had the listed status, and that in itself gave a little bit more impetus to act. Picking up on the question earlier about trusts and providing loans to trusts. Well, this building was owned by a not-for-profit charitable trust, and that was quite key as to why they couldn't do anything with it and why they needed our help, and I'll come on to that. It was part domestic, part storage, so it's a bit of commercial, if you like, above. And one of the key things is that this trust had a constitution which prevented them from selling the property, and basically they didn't have any money. So and they were paying 400% council tax on the property. So you can imagine the sort of pressure that they were under. Our normal response as Ellie outlined, you know, when we're being sort of fairly abrasive with these sort of things, is, you know, sell the property, do it up for rent, do it up to live in, you know, that's the three options. Pick which one you're going to do. Doing nothing is not an option, but in this case, you know, a number of the options just weren't available to them. And what they basically said, we need a benefactor. You know, we need somebody to help us, and that's where we the council were able to step in. Right, next slide. Here we go. So, Dorset Council is a new unitary council, and it was formed in April 2019. So we're 4 years young. We're still finding our feet. Now, as Ellie explained, the loans from Lendology have been available for many years now in various guises, and for historical reasons, they were only available in 2 out of the original 5 district councils that formed the unitary. And as the unitary started to take shape and the walls came down between the different district areas, then the loan pot was extended across the whole of the county, which was, you know, a fabulous moment, and enabled us to help everybody across the whole county rather than more of a postcode lottery. So we had a regulatory reform order policy. I don't know if that arrangement exists in Scotland, but it was a housing assistance policy. We're able to offer assistance if we have a policy which determines how we're going to do that, and that detailed £25,000 loans available for empty properties. Now, critical to this as well is that the new authority made tackling empty homes a corporate priority, and we one dedicated post, which is not particularly generous, but we were allocated initially £744,000 for empty homes funding over 2 years, and the main aim for that money was to really progress CPO action, but we could use that for pretty much anything really. So we could be a little bit creative. And although the focus is focused on enforcement, this property looked like a bit of an easy hit for us and a good place to start when we were this fledgling local authority. So the proposal, basically, the trust were very proactive in what they were doing, and it's probably no surprise, you know, they're paying 400% council tax, they're desperate to do something, and they came up with a scheme. They got listed building consent, and they had building regulation consent, which is a miracle in itself for this sort of thing. And the predicted costs were to form just a 1-bed flat. Basically, it was £50,000. So we had the £25,000 loan that we were able to offer as part of our standard policy, and you know, just to get this property over the line and to get it off of our books, which has been on there for 22 years empty, we'll give you a one-off grant of £25,000. We'll pay for the whole thing, and we'll just get it done. We'll get it finished. And now, you mentioned about nomination rights. Because we were in quite a strong bargaining position, we basically said, if we're going to do that, we'd like 10 years of nomination rights. Now, normally we'd go for 5, but I think because we were offering the grant, it's free money, we wanted quite a lot in return, and basically the trust, they sort of bit our hand off for that. So that everybody seemed happy with that arrangement. So that's how it sort of played out. So just some basic things that we needed to do right from the get-go was, and some of these seem quite obvious, but just not to be sort of forgotten, is there a demand for this type of accommodation in the area? It's no point going into all the effort of refurbing, providing all that money, nomination rights, and then suddenly find out, oh, we don't need that property there, it's too isolated, we haven't got demand. So, but this was a bit of a no-brainer. It's in the middle of town, and easy access into the town, and there's high demand. We have no problem filling it at all. Now, the trust were basically run by committee, and they had to get agreements to everything. I mean, from that respect, they were almost worse than a local authority. They and even down to the fact that we had to make sure that there was within the constitution that they could actually borrow this money, and that they weren't in breach of their constitution in some way. doing that. We had to get that, the land was unregistered, so it had to be first time registration was needed to get that restriction in place that Ellie talked about. And just another point, just to fulfill the nomination rights, because the trust could have managed the lettings themselves, that they just said, well, you can lease the property from us. So we leased the property from the trust for 10 years in return for a guaranteed reduced rent. I think that was at local housing allowance level, and we were put a lease together and to be agreed with the trust. And the one-off grant we offered fell outside of our agreed policy, so we had to get what we use here quite a lot is an executive decision notice to get that agreed as an exception to our policy. That was all fairly straightforward, but it just means that we can get it formally agreed without having to go to committee and all that, all that sort of time issue that it can take. So the sort of how the process works practically is that we basically introduced the trust to Lendology, who struck up that relationship with the trust and basically did their own kind of due diligence into the case. Does it fit the process for loaning this money? Lendology send out an application pack to the trust, and then sort of all parallel to this, our legal team just start devising that lease for that particular building, because they're all sort of kind of bespoke for each one, even though there's kind of a template in place. The trust went away and they got quotes for the work that they needed to do, all the refurb work, based on a scheme that we had approved that was basically there was a specification for a full plans building reg submission, and we used that as our spec of works, if you like. So when the loan and grant were approved, in a traditional sort of grant way, the spec was just attached to the was attached to the approval documents, and then that was what the grant would be paid on, no more, no less. So the trust legal team got the first registration done. That I just said that sentence in 2 seconds, but I think it took months for that to be done, and just because it was just quite problematic for some reason. The grant application forms were completed by the trust, so they had to fill out a set of loan forms and a set of grant forms. And we did share that one of the key things that, and I think I did work with Ellie on this one, yeah. We shared a lot of information, all the paperwork was shared, so they didn't have to, if I got a bundle of paperwork, I'd send it to Ellie, and then if Ellie got a bundle of paperwork, she'd send it to me. So we tried to avoid that duplication. And then the loan and grant was approved once the lease was signed. The lease was a critical thing that, until that was signed, we wouldn't release the money, because that was what sort of held them into the funding arrangement and got our bit out of the process, if you like. So so the lease was signed and the work commenced, and what we did was, in typical, no different to what you do with a grant, there was a series of stage payments. I think we had 3 interim payments and 1 final payment. The loan was drawn down first, and so Ellie, would receive invoices, or I would receive invoices, and we'd share that documentation, and then Ellie would release that payment. And then when that was done, the grant took over and paid the balance. And then we were carrying out checks of the work as we went, and also our building control team were involved in building regulation compliance, and they provided us with that assurance as we went along that everything was satisfactory. And then we got into completion, with all the necessary certification. We did just a couple of things we ran into. One was that it turned out that the flat didn't have its own water supply, which was shared with the adjoining building. So the trust the trust owned the adjoining building, and they were going to do some sort of estimate of water usage, which had nightmare written all over it. So we did agree that we definitely wanted that a separate main supply into the properties. We agreed that as an additional item of work and got a lateral run in and a separate metered main supply. And then also on a visit, and this is quite common, I don't know if this is a problem up in Scotland, that on the specification it said the heating was down as night storage heating, which was okay with us. And we turned up on site on one of the inspections and found that the contractor had started to install peak electric panel heaters, the so-called super efficient panel heater. So we were insistent that they were, look, there's the specification, that's what we want, that's what we need, that's what we agreed, that needs to go in. And that was probably our only sort of flaky moment, really, when but that was all sorted, and that was key for us, because we wanted to ensure that the running costs obviously were reasonable for the heating, and also that it complied with minimum energy efficiency standards. So the final payment was made. A bit of an apology, actually, because there's no decent pictures of this, because this is one of our first jobs that we did in our fledgling policy. We hadn't sort of cottoned on to the idea that the before and after picture was absolutely key. So that's why you're looking at the same picture over and over again. But now we're much more savvy about, because councillors especially love a good before and after picture, and it always looks good in the paper as well. So yeah, so the just the final bits of the process, a schedule of condition was devised as part of that lease, and the owner would, or the trust would, get the property back less fair wear and tear, whatever that means over 10 years. I'm not entirely sure, but that's to be resolved in 9 years' time. Contact the valuation office because it needs to be rebanded for council tax. And we had a tenant identified, and they moved in when we had I put a grand opening. It was just a mini opening, basically. The trust was actually the Masonic Lodge, which was next door. So they actually did a lot of good causes in the local area. So they were thrilled that they were able to, take this weight around their neck and turn it into something that was essentially like a small community asset, really. So the outcome, long-term empty property returned to use, which had been 22 years empty. A local home provided. I know it's just a one-bed flat, but it's still moving in the right direction. Listed building saved. The trust were no longer paying £4,000 per year in council tax, so that's good for the trust, not so good for the council. But we got the empty property back. They get a rental income. It helps with our temporary accommodation, and it was generally a good news story. And the councillors were very happy to stand there and have pictures taken with the with representatives of the trust. Just some points about working with Lendology. I think one of the things that I picked up with this is that a lot of officers that do this work have got a typical background in doing grant administration, and it's a bit of a journey when you move from grants to loans, in that the grants are often audited, scrutinised to the nth degree, with every penny being monitored and every bit of the specification being pored over. And I think loans are an opportunity to take a little bit of a step back, and be a little bit more flexible. And I think that's pretty critical in these sort of cases, really, where you're not penny pinching over what is their loan, and they're going to repay back in the end of the day. You can be a little bit more relaxed about it, and that's a journey that most sort of officers have to go on to take that hands-off approach a little bit. I think with this one, we worked really closely with Lendology to get it over the line. We were fixing problems all the time with this case, just encouraging, fixing, giving advice to the trust, nudging it along, keeping it going. And I think if both of us hadn't have been on on that case, you know, it would have dragged on and on and on. And I think even with that 400% council tax hanging over them, you know, there were lots of things to fix along the way by way of getting it over the line. And I think that's the nice thing about working with Lendology, you know, and things that can't be understated is that, you know, it's a trusted partnership that we've got. There's no profit motive for them, and they basically share the same aspirations as what we've got. You know, you've heard from Ellie about, you know, bringing the property back into use. You know, when you're working with a partner that shares that aspiration 100%, it kind of makes the whole thing a lot easier. You're both exactly singing off the same hymn sheet. So on that warm and fuzzy note, I'll conclude, and I hope that was interesting and useful.
That's great, Stephen. Thank you very much. So just have time for like a couple of questions, just some brief questions there. Does anyone have any questions after the presentations?
I think Karen Guest.
Yeah.
Close brackets.
Hi, sorry, Walker. Can you hear me okay?
Yeah.
Great. What it was I kept getting put in and out of the meeting, so I'm sorry, I went onto my mobile phone. It was just, I might have missed this, but the original funds, let's say we wanted to work with Lendology, how much would the council put into the fund? I missed that.
No, you didn't miss it, Karen. I didn't answer that question because you know, that's the most challenging part. Problem we have to try and solve. You know, back in 2003 when we set the scheme up, the councils had grant funding that they could just move over, or they bid to central government to get the funding. As I say, we're talking to over 40 councils at the moment about how to set up a partnership, and the two biggest problems are procurement and finance, really. When you could borrow from the public body loans board, you know, at 2% and lend it at 4%, it made sense, but now it doesn't even make sense to do that. So it's challenging. We would say to set up the minimum investment to set up a new project, specifically if you were just focusing on empty properties, you'd be looking at about 300,000 minimum capital. Now, obviously that does recycle, but it would take, you know, if you lent that 300 in a year, it's probably going to take a few years before you've got it, you know, back into the pot. So yeah, it's something we'd explore on an individual case-by-case basis, but I don't have an easy answer, unfortunately.
Did you want to come in there, Stephen?
I was just going to say that it is a looming issue for us as well, because capital is going out of the door quicker than it's coming back. So I think, you know, for Dorset, you know, we will need to consider, you know, because it's a discretionary function, you know, how we would have to make a bid, you know, for additional capital funds to top up our pot if that's required. I would say that, you know, as Ellie said, you know, the majority of the money that's going out is to single homeowners, or, you know, not to empty properties. So and basically you can, if your priority is empty properties, you can just put the money into that. If your priority is something else, you can put your money into that. It's absolutely down to local authority how they focus that money.
And Joanne, you had your hands up there.
Hi, yeah, Karen kind of asked the same. What I was wondering. So just to clarify, so we would have to find the capital, but you would manage the loans going out, and then that's what. Okay, that's fine.
Yeah,
thank you.
And obviously we provide a comprehensive quarterly report, you know, capital out, capital back, you know.
Yeah, okay, thank you.
Okay, so I'll move on to the next section if that's okay, but if anyone has any questions we haven't covered, you know, please put it in the chat. Okay, over to you, John.
Thanks, Sam. Good morning, everybody. My name's John Lee. I'm the Community and Business Development Manager at Ecology Building Society. We're a mutual organisation based in West Yorkshire, so down south today. We think we're up north, but today we're down south. We lend all over the UK and provide mortgages and savings. I'm just going to share my screen so you don't have to look at me for any longer, at least not in widescreen. Bear with. There we go. Are we operational? Yeah. Okay, so that's us. That's our office in a little place called Silsden in the Yorkshire Dales. Nice place to work. As I say, though, I think we're untypical of the building society movement in that we're not geographically focused. Our focus is very much on the impact of our lending, and we were created back in 1981. Was still the youngest building society in the UK, which is a bit depressing. But really by a bunch of activists at the time involved with the Ecology Party, although we're not party political, I must stress that. That's now the Green Party these days, and they identified gaps in the finance sector, particularly the mortgage market, in terms of being able to provide finance for projects that were, quote, non-standard construction. And that even means things like timber frame, which I know, particularly up in Scotland, is extremely common, and probably one of the reasons why Scotland's actually our biggest area of lending across the. It has to be said, quite a lot of that is self-build, new build in quite rural communities. We do provide support, however, for people wanting to do deep renovations and retrofits of properties, including empties, which is why I think Sam invited me to say a few words today. I think it's fair to say we're not directly in competition with Lendology. I was really fascinated to hear how their projects work. I think we can perhaps plug a few gaps here and there with projects that have a slightly different profile, and I'll talk about that in a bit more detail. But effectively, anything that we do from a lending perspective needs to have a positive social and environmental impact, and clearly bringing empty homes back into use in a sustainable way is a no-brainer in that sense. Easy to say, more difficult to do. I won't dwell on this too long, but our focus on housing as a building society, you'd expect quite a lot of our lending to be on housing. It isn't all, and I'll come on to some of the other things that we do. There's interesting questions raised already about community assets and things like that, which is of interest to me. But as we know, that the housing sector is a huge issue in terms of CO2 emissions. We've got a massive retrofit problem. And if we're ever going to get to net zero targets by 2050, we need to up our game considerably. I think, from my perspective, looking at what's happening in the finance sector, we're getting mortgage lenders and banks having to, quite rightly, measure and manage the impact of their lending in terms of CO2 emissions. The problem that I foresee with some of that is that we could end up with lenders focusing purely on lending on high EPC rated properties and leaving people with properties that need a lot of work with even less choice, and at worst becoming sort of mortgage prisoners, which is not a place anybody wants to be, particularly in a rising environment of interest rates at the present time. Some interesting stats came out, I think, on the whole retrofit approach from the Citizens Advice Bureau early this week, talking about potentially a £40 billion benefit to the UK economy if we were to tackle the retrofit challenge and get a minimum of EPC C ratings across the UK. I know Scotland's leading the way on legislation on that. And quite strikingly, even putting a figure on the number of lives that could be saved at 6,000 a year, which is pretty stark number. So I'm just going to, without a hard sell, just talk a little bit about how we try and incentivize improvements in the built environment, because really, as a mortgage provider, one of the sort of tools that we can use is how we price our products, and so the way that we seek to help with that is to provide energy efficiency improvement discounts across our residential mortgage products. So you start with a standard variable rate. That's currently 5.79%, maybe subject to some change in the next week after the Bank of England helpfully adding another 0.5% on the cost of borrowing. But the idea is that you borrow at the standard variable rate, and then you get a discount off your mortgage once the product's completed, once the project's completed, whether that's a self-build, whether it's a renovation, a conversion. And in the case of retrofit, that's based against the EPC level. So for each step up the rating, and empty homes tend to be pretty low rated for obvious reasons, the borrower then gets a discount of 0.25% for each step up. So as you can see in the example there, you've got a step up from E to B, and the EPC discount increases for each step up that ladder. We also have separate discounts for some of our very ambitious customers who want to do ENERFIT. So that's the sort of passive house equivalent of retrofit, where they can get a discount of up to 1.5% off their mortgage, which, when compared with some of the fixed rates and so on that are out there, is very competitive indeed. So just to recap, we're about lending on environmental benefit, not just the financial aspects, although of course we like any lender, we're regulated. We have to go through the same affordability checks for our borrowers as anybody else. There are some things that we can't do, and I think it's sensible to say that. We're not an unsecured lender. We can't do really small loans. It's just not practical to go through the rigmarole of having a mortgage on a really small amount of money when you've got valuations and legal fees and all that sort of thing to consider. We also have our criteria, as all mortgage lenders do, on credit history. So there are certain cases that we can't do if people have got adverse credit history in recent years. So I think it's just important to make that point and be honest about that. What we do, because we're a fairly small player, we're not a sort of factory of conveyancing like some of our illustrious larger competitors. So we tend to have a very sort of bespoke, personalised underwriting approach. We talk to borrowers. We work in partnership with them over a long period of time, as quite a lot of the mortgages we do require stage payments. They require reviews of how the project's going, and we do also signpost and work with a range of organisations that can provide good independent advice on a practical level as to what sort of works they might want to consider. We're not energy efficient consultants. We're mortgage underwriters at the end of the day, but we do find ourselves, after years of doing this, well plugged in with organisations that can offer that kind of practical support. And as I say, once the project's finished and we've had evidence of the improvements in the property via a fresh EPC, we can apply the discounts to the mortgage, which stays on the mortgage for the rest of the duration of however long the borrower stays with us. That all applies to our residential mortgages. We have a slightly different approach to community-based projects. And in sort of, I've focused here on community-led housing, which is a big area that we get involved in, and that can include new build, it can include renovation projects, it can include and does include some bespoke organisations that are tackling bringing empties back into use in local communities. So you're probably familiar with the self-help housing organisation that has loads of organisations and case studies on its website looking at that very subject of kind of getting to the parts that perhaps even local authorities struggle to reach at times, in terms of identifying empties, working with current owners, looking at bringing a sort of an empty homes doctor service into play, and picking up some of these properties to create not only new affordable housing for the local community, but in many cases doing some really innovative training and work opportunities with people who are in acute housing need, which has a massive social impact, as well as bringing the sustainable element of the property back into a decent spot. And we can lend, as I say, up to £3 million on community projects for groups, and up to 80% loan to value. Couple of little examples. This is a co-housing scheme in Sheffield, which was a deep retrofit of a listed and pretty derelict farmstead of buildings. They're working on it one unit at a time, and getting through this over a number of years to create sustainable housing and a sustainable community for their members. If you've got 5 minutes, it's well worth having a look at their online blog as to all the other stuff they're doing, which is absolutely fascinating. But in terms of the property itself, as you can see, a bit of a before and after there, working to a very high and attractive standard indeed. It's not all about the buildings. Somebody mentioned land, and also other aspects of improving sustainability. We have a housing co-op customer in Wales, for example, who have already retrofitted their property as far as is financially practical, but took out a further advance from us to then put solar PV onto their land to create or to get further towards net zero. So, we are interested in the wider picture, not just insulation, not just putting new boilers and windows and so on in. As you'd expect, we're keen on renewable energy technology, but also about low impact land management as well. And I'd like to stress that, I've not focused on this in today's presentation particularly, but we do also look at business units, at retail space, at community amenities like shops and libraries and pubs and all that sort of thing. So again, excuse me, applying that sustainable criteria to any of those lending opportunities, we're happy to speak to organisations that you may be in touch with. Just want to sign off and finish off with a few key issues, really, just to summarise. For us, we're a mortgage lender. We need a first legal charge on a property. That doesn't mean we can't work with other funders or with local authorities if they want a second charge, or if it's a big project and need a shared first legal charge, we can consider that. But we don't do second charge lending. So if somebody's already got a mortgage on the property that you're looking for support from us on, we would either have to say, sorry, we can't do it, or we'd need to think about uplifting that existing borrowing to be able to lend. And clearly that means that for that to be worthwhile, it probably needs to be a reasonably considered, well, a reasonable amount of spend to make it sensible for people to consider going through that rigmarole. I've touched on specifications. We look at each case on a renovation basis, on a case-by-case basis, but we do look for a minimum improvement in the EPC rating of 1 step. Otherwise, if people are just kind of changing the light bulbs, it's really not something that we're that interested in. We obviously, there's a question of payback, and we do have a really weird set of circumstances at the moment where we've had massive hikes in the cost of energy, coming down a little bit with the energy cap, but still, way above levels a couple of years ago. And we've got a rising interest rate environment, which shows no sign of abating at the moment. So all of that said, doing a decent payback analysis of the sort of spend and repayment time of that investment, as well as future-proofing the property and the value of that property, all needs to be factored in. And for that, signposting to sound independent property-specific advice, I think, is a huge issue, both for us and for local authorities and other groups engaged in this space. Looking at flexibility, I think, I mentioned stage drawdown so that people aren't incurring the full cost of their borrowing until they actually need the money, so they can draw it down in stages. We can offer flexibility on interest-only options so that if, for example, they're going to rent the space afterwards, that they're not being asked to pay capital back before they've actually got an income stream from the building. And as I say, we're happy to talk to owner occupiers. We're happy to talk to landlords on a buy-to-let basis, and certainly to community groups and organisations. And I think to sort of finish on a positive, I think, you know, we work best when we're working in partnership with other engaged organisations, and that could be other providers of social and environmental finance. It could be organisations advising on tackling climate change, supporting the natural environment, and there's a few logos there of some of the organisations that we're plugged into. I think it's patchy in terms of the advice that's out there, and it's probably the case that we'd love to see a more national approach, national coverage for some of this stuff. But you know, we are doing our best to find out who's doing what, and if there's anybody out there on this seminar today that thinks we should be plugged in and engaging with you, then please do get in touch. Thanks very much for listening. There's my details. I'll be happy to hear from you.
That's great, John. Thank you very much. Any questions at all? Andy, you had a question.
Yeah, thanks. I was just wondering, 'cause it sounds absolutely fantastic with the presentation. I'm just wondering, when it comes to the sort of loan to value for properties, do you look at what the property is currently worth or what it will be worth once any refurbishment, any retrofitting is taken place when you're establishing how much can be loaned?
It's both, Andy. In short, we look at what the current market value of the property is and ask our valuer to provide effectively a sort of red book valuation, which will give a projected value on the special assumption that works are conducted to a decent standard. We'd ask the valuer to also comment on the costings that the borrower is providing to make sure that they are realistic in their opinion, and that's where the stage payments come in, really, that you can release funds on either a loan to value or in some cases a loan to cost basis to get to that point where you've got an end game of property value versus total borrowing. The maximum we can do is 80% on a prevailing value basis, if that makes sense. I should add, that's for community projects. For renovation lending, we can do up to 90% for individuals. I think that's, I perhaps missed that out of the slides, so please do bear that in mind as well.
Thanks.
Joanne?
Hi, yeah. I'm just wondering, when you're saying you would have to have the first legal charge, so would it's basically just asking, like, you know, we've got a lot of empty homeowners, and which ones would actually be that this would fit with, and I'm kind of thinking, would it be people who are remortgaging or who have no mortgage and want to refurbish the property? Is that the kind of, am I getting that right?
Yeah, I think that's spot on. And I think the point I would make as well, maybe just to reiterate, is it depends on the size of the project as well, and the budget that people are putting forward. Because, you know, with the best will in the world, if people want to borrow 5 or 10 grand to do a little bit of work on a property, whether they've got a mortgage or not somewhere else, it's probably not, it just isn't cost effective for them to be entering into a new mortgage to do that, unless they're on some very draconian terms elsewhere. So we need to be realistic, and I certainly don't want to be, you know, trying to give the impression that we're the answer to everybody's prayers on each and every case here. We're not. I think it's the more substantial retrofit projects that tend to suit the sort of more limited financial instruments that we can offer as a building society, if I'm honest.
Thank you.
And Moira?
Hi. I had a phone call from a landlord a couple of days ago, quite concerned about the new energy efficiency regulations coming in for private landlords. He's got 15 properties in a rural area, and they have to be brought up to EPC energy level band C, I think, by 2025. And he was saying there's no way on earth he could afford that, because he's got 15 properties. They're rural, they're older properties. So is that something perhaps that we could refer landlords to you for?
Yeah, I mean that's an interesting case in microcosm, I think more we tend to get involved with projects that are where those kinds of properties are often then being sold by private investor landlords into community ownership because of some of these issues that you've just described.
Yeah, he mentioned that. Yeah.
Yeah. So I think we've got a really interesting market situation at the moment where private investor landlords, for a variety of reasons, including obviously interest rate rises and the legislative drivers, are this is a generalization, but we seem to be seeing people trying to divest from that market more and more, and that in itself creates some opportunities because there's properties out there that could be recommissioned and could be made good for the long term. But whether there's that many private landlords who are up for that challenge and want to invest in those sort of historic housing stock is an interesting one, especially with interest rates on the rise. So it's a massive challenge, but absolutely we'd be happy to speak to them and try and do a little bit of modelling as to what the sort of net costs would look like. Obviously, then for them to decide whether that's something they want to take on.
Perfect. Thank you very much.
Okay, I think I'll make this next question the next one before we take our break, if that's okay, and I'll make sure to share, contact details of the speakers afterwards if anyone wants to follow up any further inquiries. Gillian, you had a question.
Yeah, it's just more perhaps some of our more risk-averse local authorities about referring people to particular financial products or lenders and things like that.
Yeah.
I suppose my question is around, we work very closely with an organisation in Scotland called Under One Roof, who are very much to do with retrofitting and property and owner repairs. And we refer landlords there, we refer owner occupiers there, we refer empty homeowners there for advice and information. Is that an organisation that you've heard of or that you work with at all?
Gillian, I've just written them down, which suggests that the answer to that is no, but certainly it sounds like somebody we should be speaking to, which is really helpful. Thank you. And look, I totally get that. We're not here to expect you to become sort of de facto mortgage brokers in the public sector. I absolutely get that you've got to be really, really careful. And by the way, so do we in terms of financial promotions, because the more information you try and give out to people, the more potential there is for guidance to not be followed. If we start talking about rates, we've got to talk about risk warnings and all of that sort of thing. So that's certainly not why I'm here today, to expect local authorities to suddenly be channeling all sorts of business our way. I think it's more about an awareness, and if you've got another go-to to have a chat about from an advisory perspective, it's inevitably it's up to the client at the end of the day as to where they go. But I'll certainly look at Under One Roof up and have a chat with them just to make them aware of what we do and find out a bit more. That's really helpful. Thank you.
Mike Heffron's their chairperson, so you might want to speak to Mike Heffron. Thanks.
Okay, brilliant. Thank you very much.
Great, thanks.
Great.
Okay, so
well, thanks for asking me to speak today. Wendy and I are both on the agenda. I'm going to sort of lead the presentation, but Wendy might come in to answer any questions. I'm going to speak about our Empty Homes Loan Fund, which has been quite successful over the years. As an introduction, I'm Carleen Doherty, Vacant Property Development Officer. We're based, I work closely with Wendy Snedden. We are based within the Business and Place Development team within the council, and we work really closely with other job roles which work on empty homes in the private sector housing team. So although I'm speaking about the Empty Homes Loan, I thought it'd be quite useful to give an overview of the other financial support mechanisms that we've got within Perth and Kinross, because it's important in terms of how they interact with the loans. So sort of first of all, we've got three loan grant options, and the first one worth speaking about is the feasibility grants. So these provide feasibility funding for vacant or underused properties and are available across the whole council area. They're a really great stimulus for projects, and we're able to provide match funding up to 50% for individual projects of £3,000, or for larger projects, £5,000. The budget for this is a recurring fund, so we know that we've got it year on year, and in each year we tend to support about 20 projects, and the money comes from reallocating from the council tax surcharge. So that's how we know we've got it year on year. We've also got, quite often when people have a feasibility grant, obviously the next stage is actually delivering that project. We've got capital funding called Adapt Your Property, and that's really adaptation of long-term empty and redundant properties to attract new uses. So really focused on city and town centre projects, given the changing role of these areas, offices that are no longer used, commercial properties that are no longer used. And we're really looking to attract a variety of, well, new commercial uses, but particularly increased city centre and town centre living in a variety of different housing types and tenures in that area. It's not a non-recurring budget. It started in 2020 during the pandemic. We were given some economic development money to put into city centre adaptation projects. And since then, we've been lucky to have it year on year. Last year, we supported 13 projects, 7 of which were residential conversions, which resulted in 23 homes being created, and resulting in 34 bedrooms, which was a sort of grant intervention of roughly £12,000 on average per bedroom, but that resulted in £20,000 per bedroom of private investment. So it just goes to show that these adaptation projects do require bigger budgets and things like that. We've also got Empty Homes Initiative grants, which is managed by our colleague Andy in the private sector housing team. This is specifically targeted at long-term empty homes that need renovation to meet the repairing standards and are then specifically rented out at affordable rates. It's managed by the housing legislation, so there's specific things that can be funded and not funded. And it is a recurring budget, resulting in about 20 homes per year being brought back into use. And I believe this is council tax, funded from second homes charges from council tax, and it's very much focused on areas of known housing needs. So in terms of an overview, there's very feasibility grants can be accessed from any property across the local authority area. Adaptive property grants are really focused on city and town centres, leaving a gap for other empty properties across the region. And Empty Homes Initiative are focused very much on creating affordable housing in areas of known housing need. So that leaves a gap very much for where loans come in handy, so our Empty Homes Loan Fund, I'll come on to the timeline and the history of it in the next slide. But we have interest-free loans available, which are repayable generally over 5 years, but that is negotiable for depending on the project and can be repaid over up to 9 years. They are loans available of £5,000 to £20,000. It used to be £15,000, but that was increased in 2017. Again, I'll speak about that when I'm talking about the timeline. We've got loans that are available to let. So if a loan is accessed for let, it needs to be let out at LHA rates for a minimum of 5 years. And then loans which are also available for people looking to sell the property once it's been done up. But then it needs to be sold within the open market shared equity scheme sort of rates that are set by the Scottish Government. So there's a focus on supporting 1 and 2 bed properties. As I said, projects, because we've got grant options, projects will tend to go for those if they are eligible, but in some cases there's still a gap in the project finances in terms of making a project stack up. So the loan can come in really handy for that, bridging that gap, especially because we know that private finance is harder to access just now, and there's a limit in terms of percentage of project value that private finance is able to meet. Yeah, so the application process, as sort of spoken about already by some of the other speakers, is quite detailed for our for our loans, sorry. Then we need a schedule of work, and we need to see at least 1 quote, 2 quotes if it's a bigger project. We need to see evidence that the rest of the budget is in place to enable the works to go ahead. So if that's a bank statement showing savings or a commitment from another lender, we need to see that evidence. Something that was touched on by John in the previous presentation is securing the loan. So we do require a standard security to be put in place, and different to what John was saying, we will accept the second charge because we know that if there is other private finance, they will require the first, and we accept that. That's the same for our grants. For larger grants, we will accept the second charge because we require a standard security for those as well. We require there to be double the amount of equity available in the property to secure our loan against. So if it's a £20,000 loan, we require there to be at least £40,000 of equity. And we need to see a valuation of the property, primarily for once after the works are complete, because we secure the loan against the works, the value of the property once it's complete. But it is obviously useful to have the valuation of the property in its current condition, so that we can assess the need for the loan and different things like that. If the property is going to be loan to let, then we obviously require landlord registration to have gone through. And this goes across the piece for all our loans and grants, that we do a debt check within the council. So if any of the applicants have debt to the council, primarily from council tax, but it can come from other sources as well, and they are not eligible for any of our sort of financial support schemes. From loans or grants, different for council tax, but that's another conversation. Anyway, so on the slide here, you're seeing two different pictures. So at the top here, this is one of the first properties that we were able to support with the Empty Homes loan. It's a 3-bed rural home. It used to be a schoolhouse and been empty for 2 years. I think the overall project was about £70,000, and we provided a loan of £20,000, and this has been, I think that was in 2018, and so the majority of that loan will have already been paid back, and it's been a good success. The picture below is the former doctor's surgery in Dunkeld. When that ceased being, a new doctor's surgery was built, and so this was an empty property that was looking for a new use, and the owner decided to develop it as 3 2-bed apartments and an office. And we provided a £20,000 loan specifically to support the development of the ground floor flat on the left-hand side to become an accessible flat. And you can see that there's a disabled friendly access on the left-hand side. So although we only provided a loan specific to one part of that building, it enabled the full sort of project to go ahead. Operationally, this is just an example of how we assess and speak about the loan repayments with applicants. So if there's a £10,000 loan being repaid over 5 years, and it's been let within the local housing allowance rate, which is obviously the requirement, it just presents how much income would be remaining to enable them to think about actually what repayment period they do need to repay over if they've got other debt that they're paying back at the same time. So we support the applicants to make that full application. There is quite a lot of evidence and supporting documents that are needed. So as a vacant property team, we support applicants through that process, and then legal team undertake the legal checks that are necessary before it's submitted for director level sign off. The loan agreement is then issued by legal, and they deal with the standard security and things like that. And then the loan is paid upon completion of the works, and repayments are then handled by finance. So once that sort of first stage is sort of signed off, the majority of the vacant property team don't have a whole lot involvement from that date. It's all in play kind of thing. Okay, so in terms of the timeline and success, so our Empty Homes Loan Fund really started in 2015 when the Scottish Government provided Empty Homes loan funding to Scottish local authorities to set up their own loan schemes. We were provided £350,000, and when we went to committee, we specifically did say that we were earmarking £250,000 for larger city centre developments and £100,000 for individual sort of property size projects. fast forward a couple of years in 2017, and actually I think this is reflective of a lot of local authorities' experience, that we hadn't had any success, we hadn't given any loans out. And so there was a review of why that was, and I think one of the barriers was that actually the value needed to be increased a little bit in the 2 years since it had initially been set up, costs had changed and things like that. So we got approval to increase the maximum loan per property to £20,000. Originally it was £15,000. And thereafter we did have more success. So we have notably actually only given 4 loans out, but that has resulted in 21 properties, 21 homes being brought back into use. So the photo on the top right here is a conversion of a city centre office. So if you know Perth at all, this is on the corner of St John Street and South Street opposite McEwan's, if you ever came shopping to Perth. And its conversion, it'd been empty when the loan was awarded. For 2 years it had been empty, and it created 13 1 and 2 bed flats right in the city centre. So really on target of what we're trying to promote. We know there's a lot of housing needs, there's a lot of demand for this size of property in that location. So it was a great outcome. And the project you're seeing on the bottom there is a tenement property that had was in dangerous condition with dangerous buildings notice on it, and the buildings at risk register. And it's also a historical property, so there were issues around what you could do to the property, and obviously the gap in how much a project would cost to bring that building back into use. And it's right in the city centre. So we were actually able to provide a loan to a charity to purchase the building, and they have since then raised funding other places to bring the building back into use. And there's been a lot of money needed to do all the repairs that are needed structurally to the building and fit it out. And it'll create 4 affordable flats to provide independent youth housing and emergency accommodation, which we know there's a real need for in Perth. So since 2018, so we'd awarded 330,000 of the £350,000 that was originally allocated. We have had ongoing interest, and we've had absolutely no repayment issues. Finance have confirmed to me, which is, really good to know. I know that people would maybe be concerned about that. Because of the ongoing interest and the fact that some of these loans are now almost fully repaid, we managed to get committee approval to turn the repayments into a rolling fund. So although that we have paid the original £350,000 back to the Scottish Government, the repayments that are coming into us from the loans are now able to be re-awardable. So yeah, it's a rolling fund. Obviously there is we have got all the grant funding options that I went over on the previous page now, but I do think there is a real where I see us making most use of the loans is for projects that are like the one on the bottom here, where they're a real problem eyesore in our city centre, and the value of the project just really doesn't stack up without having additional financial support, because external lenders just aren't really going to come to the table on it. And I suppose just to round up where we're thinking of going next is, I think I spoke in the forum about, does anyone have a loan to stay option? And it's been mentioned for owner occupiers from a few of the other presenters. That's something that I think we're going to look at. We've got more people looking to convert properties to residential in the city centre, and it really links well with having a mix of tenures and property types. So owner occupiers wanting to bring properties back into use and convert them. I think there's probably also a review needed of the maximum value per property. Since 2017, costs have changed considerably. And yeah, I think that's what's maybe worth pointing out is that there is, with all the loans and grant options that are available, there's a maximum amount of team capacity within the team to manage all these different things. And with grant funding, that being an in-year budget, there tends to be a priority given to making sure you can get that money out the door to the appropriate projects. And so it's making sure we've got capacity to operate the loan scheme, which, because it doesn't have that in-year demand, can sometimes be a wee bit more forgotten about, I guess.
So the Town Centre Living Fund, which is what Dumfries and Galloway offers, aims to increase the supply of affordable housing in town centres by bringing empty properties back into use and improving quality of existing homes that we have. The funding for this comes from the council tax second homes income, and there's £1 million allocated every year overall, and it's divided into 3 different strands. So if you want to put on to the next slide, please. So the Town Centre Living Fund is the main allocation. It's half of the money at £500,000, and it's not only housing projects, but most of them do turn out to be housing, but they also have wider regeneration outcomes. And this fund's open to charities, community groups, private developers, registered social landlords, all sorts of groups really, and it helps with a range of work. Sometimes it can be surveys or site investigations or, feasibility studies, that sort of thing, or contributions towards work that's planned but is maybe falling a little bit short of the budget. We can contribute an extra little bit. It only applies to town centres and settlements that are allocated in the local development plan. So because it's really based on the strategic aims of the council, which are to do with town centre regeneration, and that's where the kind of political will for this fund came from. Can we have the next slide? So these are assessed according to whether they have other funding, also how financially sound they are. They're fit with different strategic themes of the council, of the Scottish Government, and of the priorities for the particular area they're in, and community, what the communities have said they want in local place plans and things like that. They have to have evidence of, they're assessed according to how much partnership working they're doing. So it's good when you see there's communities on board or people working together. Sustainability, and all these applications are determined by committee on an individual basis, because they can be quite a lot of money that's put into these. This is the sort of biggest section of the fund. So go on to the next slide. This is just an example. It's an affordable housing that was on a derelict site, which was formerly agricultural machinery and sales. They moved to a sort of out of town place and left this big gap site in the centre of Annan. And this was affordable housing delivered by a registered social landlord, and Town Centre Living Fund made quite a large contribution to the costs of that, particularly because the site had been contaminated by its previous use. So that, it made it possible, just whereas otherwise it might not have quite been enough money to do it. Next slide. We have grant funding for below tolerable standard homes. There's £300,000 allocated to this. So homeowners and private sector landlords can apply for this and get a 50% grant up to £5,000. The majority of these applications are for roof repairs, and it's always fully allocated. We have such a lot of applications for this one that there's always a big waiting list. It's oversubscribed, and every year we have to tell people that they can't get the money, and that's a bit unfortunate. But it's also recently been made so that they actually have to have evidence of damp in their living quarters. It's not even enough to have just a bit of rain coming through the roof. So the main point of this is that it improves the quality of housing and it prevents properties becoming empty. So that's kind of how it fits into the empty properties part of this seminar. You know, some of these houses would have to be abandoned if they didn't have this little bit of extra money to fix these problems. It's very much the most resource intensive part that we do. There's a full-time officer who inspects the houses, inspects the properties. He's got a building background, so he's quite well qualified to do that. But it's you know, it's a difficult job. It's a large area, so there's a lot of that. And then there's also admin staff who all the quotes, they have to have 3 quotes and everything has to be checked, and you know, the quality of the work has to be checked, and but it's worthwhile, you know, it does make a difference to people. Next slide, please. So finally onto the Empty Properties Fund, which is really what we've been, what this is about. So this is a £200,000 allocation, and it's a 50% grant rate with a maximum of 20,000. This also gets fully subscribed every year with projects, so it tends to be bigger ones. It is £20,000 per unit, per housing unit. So quite often these are things like a former hotel or something like that. So it might actually come to, you know, there might be converted into 4 flats. So that would qualify them to get £80,000 towards the cost of that. And you know, there's good take up for this. Properties must have been empty for over a year. For council tax, you know, a year empty for council tax purposes for over a year. And after the properties renovated, they have to be occupied either by the owner and their family or rented out at affordable rates for 5 years, which gets put into the title deeds to make sure that happens. They can be residential properties, or sometimes, you know, commercial premises above shops and things like that are also considered. Next slide, please. Just to go back to the beginning of it, the origins of the fund, it was introduced in 2017, so it's been running 6 years now, and it has started to make a difference. You know, you can see in most towns there's 1 or 2 properties that have been improved by this. But the inspiration behind it, the motive behind it, is common to all towns, I think, in this country. That town centres are declining and there are a lot of empty properties. People are moving out, there's nobody living there. So this is the sort of focus that brought about there being general political agreement. Dumfries and Galloway Council has had just about every political party in charge of it and various coalitions, but there's always been strong agreement really that town centres need to be regenerated. So it has to be the political will to bring about a fund like this. But so the town centre part of it, the regeneration part, is the focus that enabled this. If you're, just to say at the end, if your empty property is in a rural area, then unfortunately the council doesn't offer anything for that because it's all focused around this particular scheme.
We did have a question in the chat earlier. Anna Gardner had asked, given the cost of renovating traditional properties can be a 6-figure sum, is there a restriction on an owner getting an empty homes loan who has another loan from a different source, for example, Lendology? And Anna had asked that question during your presentation, Carleen.
Yeah, so the answer is no. As long as there's enough equity in the property to secure a second loan against, and that meets our conditions of there being double the amount of equity left for us to secure a loan against, that would be fine. And given that commercial lenders and would require the first charge, or if there's a large grant intervention, in some cases with heritage properties they might require a charge above us, and we're negotiable to which charge we take on the ranking order, knowing that we want to see the outcome, so we're willing to be flexible as far as we can. Yeah.
That's great, thank you. I do see a bit of an answer there in the chat as well, just helpful to discuss it as well. Joanne, you've got your hand up there.
Hi, Carleen. I was just wondering, the loans that you gave out, did they also get grant funding alongside the loans, or was it just purely loans?
So at the time, we didn't. I couldn't say if they got the feasibility funding. They may well have got feasibility funding, but they didn't. The first three didn't get any grant funding. We didn't have capital grant funding available until 2020, so they weren't eligible. The final one is linked to a much bigger development being delivered by the Y Centre and the YMCA, the charity. And so there is significant grant funding in developing their wider scheme. And yes, they have had a small amount of grant funding specific for the flats, but that's because of the type of organisation and things that they are as well. But across the board, no, they didn't. The loan was enough to stimulate and support those projects, the first three.
That's great. I always, so with the loan schemes from the Scottish Government, Fife have always had difficulty in using them. I suppose it's quite good to get the big properties and focus on all of those, your numbers, I suppose. But one of the barriers that I've always found was the fact that we had to pay out after the works were done. Did you find that, and how, and if you did, how do you kind of, is there any tips on how to overcome that?
So hands up at the minute. I joined the council in last year, 2022, so I don't know exactly what went down in the conversations that were had. So I don't know. I can imagine that being a barrier. Retrospective payout on anything is often a barrier. I could, I don't have the answer, and I don't know how I would find the answer for that for you to get back to you later, I'm afraid.
Okay, that's fine. Thank you.
And Gillian, you had your hand up there.
Hi, sorry, it's a question for Gillian. I got called away during our presentation, unfortunately. I probably missed it, but in terms of your empty properties fund, how is it funded? Is it like Perth and Kinross and most other local authorities? Is it from the council tax surcharge?
Yeah, it's from second homes and council tax. Yeah.
Thank you. Thank you very much.
And I'll get to you in a minute, Ellie, but I was just following on for the question for Gillian there. There's a question from Anna Gardner saying, when you mentioned the focus was on town centres, is that the same for the Empty Properties Fund? And if so, could a rural property be eligible for support?
No, they're all, the Below Tolerable Standards Fund, it can be anywhere, but the other two grant parts of the grant are only for town centres. Yeah.
And over to you then, Ellie.
I was just going to say quickly, Joanne and Carleen, the way we get through managing payments is we just do stage payments, much like ecology. So, some councils have to accept that you might have to, release a little bit at the front and then just inspect all the way through. Or, with the project with Steve, we just accepted invoices as works having been done and then just released as we went along.
Yeah, it's quite resource intensive that then, isn't it? But yeah, I'm trying to find out whether that's a council, because our loan scheme was set up before I joined, and I'm wondering if that's a council kind of policy. To
It
pay
will
out
be,
after.
yes,
Yeah.
it will be.
Mhm.
I've had, we've worked with our, I mean, we've worked with all of our partners to say, look, you know, this is a loan, they're paying it back. We have to try and be flexible, because with some works, you know, you're not going to get with roofs, you know, the roof is happy to be paid on completion, but when the contractors buy in materials, you know, they have to have a deposit. So it's like, if you want to actually get the money out, we have to be a bit flexible.
Yeah.
Any further questions at this point? Oh, and the following question, I think this may be for Gillian again. Is that because you're satisfied with that the key demand for housing is in the D&G towns, Dumfries and Galloway towns?
Yes, I think it's demand, and it's also where you know, resources are being put in terms of things like 20-minute neighbourhoods and that sort of thing. I think yeah, I think that's the strategic hope, that people will be at least near a settlement.